We're going to first look at the derivation, the construct and the types of candlesticks and the patterns that they form. We're then going to look at patterns in specifics, different types of patterns, where we see them on charts. We'll briefly look at the importance of time frames on your chart, and lastly we'll look at some candlestick patterns on some charts. Now before we look at candlesticks in the main, what we're looking at here is a line chart, and this line chart is basically showing the close of the price on a day-to-day basis. It's giving us information in terms of trend and in terms of market movement, but it's not really telling us that much information about what's happened during the day. All we can see is where the market closed at the end of a particular day. Here we have a bar chart. Now this is a bit more informative. In the bar chart you can see a vertical line with two horizontal lines either side of it, and basically what it's giving us is information on the open, the range and the close of any particular day's trading. If we look at that in comparison with a line chart, you can see that although we can have the trend being shown to us there, we also can see what sort of activity has gone on during any particular trading day. Lastly, the candlestick. Now the candlestick chart shows us the similar information to the bar chart, but arguably it is more visual and gives more instant information to be read from the chart. If we look at it in comparison with a bar chart, you can see that the information is very much the same, but I would argue that the candlestick perhaps gives us a little bit more visual stimulus as to where the market is being in a uptrend and a downtrend, whether we've had up days or down days. And bar chart on the other hand does give us that same information, but you need to interrogate each bar in a more scrutinizing way. Now there's nothing wrong with the bar chart. It's the forerunner to the candlestick chart, but as time moves on the bar chart is becoming less favorable. As new traders come in to the market, they're learning about trading with candlesticks. So candlestick patterns. Now there are many types of candlestick: Renko, Heikin-Ashi, equi-volume, candle volume, but we're going to be concerning ourselves with the Japanese candlestick. Now the credit given mainly to a trader by the name of Steve Neeson basically introduced the Japanese candlestick method to the West from Japan. So the construct of a candlestick. We're only going to concern ourselves now with Japanese candlestick. So the candle has an opening level. It will trade and create a low. It will also trade up and create a high. And at the end of the specific time period, it will form a close. And the candle itself is only valid when it is completely formed. If you look at this particular candle, when the market opened, it was at a certain level. It then moved down, likely forming a solid bar. Then it moved back up again, it went right to its high price, and then closed further back down into the candle range. Lines between the high and the close and the vertical line between the open and the low are known as the candlestick shadow, tail or wick, and the rectangular shape between the close and the open of the candlestick is known as the body. So here we have the open, high, low and close of a candle. Now the longer the body, the further the price has moved in the particular time period. Well, that kind of makes sense because the distance between the high and the low determines the range of the market within that time period. So the longer the body, the further the price has moved during the time period. This also gives an indication as to momentum is increasing and moving price in a particular direction. So the long wicks or tails or shadows, they indicate a shift in control between buyers and sellers during the time period that the candle was forming. So buyers and sellers have come in from the open of the bar, they've pushed the market up, they've pushed the market down, and buyers have come back in and pushed the market back up again to the close. We can use the candlestick to help us identify market sentiment by comparing a current candle with adjacent candlestick. We'll see more on that later. Point to note, as I've already said, only closed and formed candles are worthy of analysis. The sentiment changes as the candlestick is forming. To use a candlestick effectively, we need to use it in conjunction with our chart analysis and the current price action. Now, candlestick patterns are time specific. They can be used on 5-minute, 15, 4-hour or 2-day charts. The candle forms within a particular time period. So a 5-minute chart, the candle is only valid every 5 minutes. Likewise, on a 4-hour chart, a candle only becomes valid every 4 hours. You need to bear in mind that Candlestick is printing historical information. It's only printing what is actually traded, what has been happening in the market in terms of buyers and sellers. And the market sentiment basically gives us an indication as to the bias, whether the market was biased towards a buyer or a seller. Multiple candlesticks, well, they help to define market structure. They also indicate changes in the momentum, and they form recognized patterns which we can learn and help us to decide where we're going to get in and out of the market. There are two main types of recognized patterns, that are reversal patterns and continuation patterns. And they also define key levels. Key levels on a chart will either be support and resistance or points of inflection, that is where the market is turning. So let's have a look at a couple of candlestick patterns. Here we have a bullish candle. You'll notice now that the body has been coloured in. The common colour used in candlestick patterns is green for a bullish candle. The candle has an open, a low, a high and a close. Now the bullish candle indicates that during the time period of the formation of that candle is opened and closed higher than it opened, which gives us suggestion that buyers have control at that particular point. Conversely, a bearish candle, in this case, is coloured red. Again, the candle has an open, a high, a low and a close. And during the formation of this candle, it's opened at a certain level and closed at a lower price than the opening level. And this again suggests to us that sellers have control at the formation of that candle. So let's have a look at some patterns. We have a bullish pin bar, and a bullish pin bar basically closes higher than the open, and it has a long tail going in the opposing direction to where it closed. So here you can see a candle that's opened, it's pushed down, and bear in mind at this point the candle was red as it was pushing down, then it came back, pushed through the open, pushed up and closed on its high. You will often see the close and the high of the bullish pin bar are the same, but you can also have a small push up into a high and pulling back to the close. The bearish pin bar, conversely, is opening at a level, pushing up initially, and again this would have been a green candle at the initial stages. It then pushed back down through the open, all the way down to the low and closed on the low. Likewise with this candle, you can have a small push down below the close, printing a low and coming back up to close. The doji candlestick pattern, basically it has a very small body, i.e. the open and the close, very close together, or they can be exactly the same level. The candle prints a high and a low in forming the candle, but then closes more or less where it opened. And this suggests a point of indecision in the market. Neither the bulls nor the bears have control in the market. Now there are many variations of the doji. I will show you two here. One is a gravestone doji. Here we have the candle has pushed up into a high, come back down and closed more or less where it opened. But the gravestone doji you will see is at the top of price action. The single lines either side of that, which will be used from here on in, are just indicating candles of any form that have printed before and after the actual candle pattern we're discussing. Here we have a dragonfly doji. Again, you'll see that at the bottom of market, a point of support or a point of inflection where the market is turning. And the dragonfly doji opens and closes at more or less the same level and has a tail that pushes down, and the market then rejects when buyers come in and push the market back up again.